Welcome to the deep dive. Today we're taking a close look at a real giant in the telecom world, AT&T Inc., ticker symbol T.
Yeah, household name for sure.
Absolutely. You probably know them, century-old company, phones, internet. But things have changed. They shed that massive media empire, Warner Media, and now AT&T is really at a, strategic crossroads.
Mm-hmm. Big pivot.
The big question we're diving into today is, can this leaner company, more focused now, truly thrive? Can it create value in this super competitive 5G and fiber era? That's what we want to unpack.
And there's a fascinating paradox here we need to explore.
Exactly. We'll dig into that paradox at the heart of AT&T's valuation right now. I mean, here's a company generating immense cash flow, but our analysis actually suggests it might be destroying value with its investments. Kind of surprising, right?
It definitely makes you look twice.
Just so you know, our analysis is current as of June 28, 2025, and we're using a reference share price of $28.08 from the close yesterday. Oh, and before we really jump in, just a quick note. This deep dive, like all our stuff, is powered by Stock Analytics AI. For just $4.99 a month, members get priority deep dives. We're covering all the S&P 500 stocks over the next few months, so members get first dibs.
And if you just want a one-off analysis on a specific stock?
Yep, just drop us a super thanks on YouTube. Easy as that.
Okay, so AT&T. What's really interesting, I think, is how its history, all those ambitious moves, some might say turbulent moves.
Like the Time Warner deal.
Exactly. How that history has really shaped where they are now. It's created both significant strengths, but also these challenging paradoxes we mentioned. We'll try and connect those dots for you today.
Perfect. So let's start at the foundation. Let's really unpack what AT&T is today. We'll call this Chapter 1, Business Analysis. So after that huge pivot away from media, what's the focus now? What are they actually doing?
Well, they've made a really decisive shift. Forget content ownership, like spinning off Warner Media. Now it's laser-focused on the core business. Connectivity services.
Right, the pipes.
Exactly, the pipes, leveraging their big investments in 5G wireless and their expanding fiber optic network. It's about distributing content and monetizing that network, not owning the studios.
Okay, so if it's about connectivity, where's the money coming from? What are the main revenue streams?
Primarily three areas. First, mobility. That's the biggest engine by far. Over 100 million wireless customers. Just in Q1 2025, service revenue alone was $20.5 billion. Massive number.
Wow, yeah, wireless is key.
Definitely. Second is consumer wireline. This is all about getting the residential broadband customers, the 15 million plus of them, onto AT&T Fiber. That's their big push for growth in home internet.
Faster speeds, better reliability.
That's the pitch. And third, there's business wireline. This covers solutions for enterprises, things like secure networking, cloud services, cybersecurity.
And the specific products, what are they actually selling under these banners?
So on the wireless side, you've got comprehensive 5G plans, like their unlimited your way. They're pushing speed, reliability, but also security features like their Active Armor cyber threat protection.
Security is a bigger selling point now, I guess?
Increasingly so. Then for home internet, the flagship is AT&T Fiber. High-speed, multi-gigabit fiber to the home, FTTH. Key selling points are no contracts, no data caps.
That's appealing. And you mentioned bundling.
Yeah, that's a core strategy. They offer a pretty hefty 20% discount if you bundle their wireless and fiber services. It's smart, increases ARPU, that's average revenue per user.
Makes customers stickier.
Exactly. Reduces churn, makes it harder for you to leave. They also have things like AT&T Next Up, the device financing, which also creates switching costs.
Okay, let's talk about FirstNet. I've heard that mentioned as something truly different. How important is that?
It's very important. FirstNet is a critical, genuinely differentiated asset. It's the only nationwide network built specifically for public safety for first responders.
Right, for police, fire, EMS.
Precisely. They have over 6 million connections, serving more than 28,000 agencies. It's not just a stable, reliable revenue stream, though it is that. It also gives AT&T this sort of halo effect around network reliability for other customers. It's hard for competitors to replicate.
So putting it all together, huge scale, focus on connectivity, FirstNet. What's the overall industry look like? Is telecom growing?
Well, the industry itself is pretty mature. You're looking at generally single-digit growth overall, but there's constant technological evolution, right? Things like fixed wireless access or FWA are shaking things up.
Yeah, T-Mobile and Verizon are pushing that hard.
They are. And then there's the impact of AI, especially generative AI. Data usage is just exploding, projected to increase something like 5 times by 2025 compared to a few years ago. AT&T themselves are guiding for low single-digit consolidated service revenue growth through 2027. But that really hinges on them successfully rolling out more 5G and fiber and nailing that bundling strategy.
And who are they fighting against? It feels like a very tough market.
Oh, it is. It's a highly concentrated oligopoly. You've got the big three wireless players, AT&T, Verizon, and T-Mobile. But you also have the cable companies, Comcast and Charter, becoming increasingly aggressive as MVNOs.
Right, using the big guys' networks, but competing on price.
Exactly. Mobile virtual network operators. They add another layer of intense competition, especially on price. It means everyone has to keep pouring massive amounts of capital into their networks just to keep up. Barriers to entry are incredibly high.
Okay, that gives us a really good picture of the business itself. Now let's just focus to the people making the decisions. This brings us to Chapter 2, Management Evaluation. How's the leadership team done, especially navigating this huge strategic U-turn? And critically, what do the numbers say about their ability to actually create value?
The CEO is John T. Stankey. He took over in July 2020. He's an AT&T lifer, been there decades. But his track record is, well, it's complex.
Because he was involved in the Time Warner deal.
Exactly. He was a key architect of that massive, ultimately ill-fated acquisition. And then he turned around and led the charge to unwind it, spinning off Warner Media and pivoting the company back to its connectivity roots, focusing heavily on debt reduction. So it's a major course correction from decisions he himself was central to.
Quite the reversal. How have they handled crises? Those data breaches recently must have been a huge test.
A massive test, yes. They had major breaches announced in 2024 and 2025, affecting potentially up to 73 million current and former customers. Social security numbers, passcodes, sensitive stuff.
Ouch.
Yeah. Their response involved investigations, password resets, offering identity theft monitoring. But the big criticism was the delay in acknowledging it. Evidence suggests the data might have been circulating since 2021, but the formal company acknowledgement didn't come until 2024.
That doesn't look good.
No. It led to a $177 million class action settlement. So while they took steps, the transparency and speed of communication were definitely questioned. It raises flags about how they handle major issues, even if they talk a lot about ethics and integrity in their code of conduct.
A fair point. So where's the money going now? How has capital allocation changed under Stankey post-pivot?
It's a complete 180. The primary focus now is investment in the core business. They're earmarking roughly $22 billion annually for capital expenditures, CapEx, through 2027. That's overwhelmingly for building out 5G and expanding their fiber footprint.
So no more giant media deals.
Definitely not. The M&A strategy has shifted from those transformative risky media plays to much more disciplined bolt-on acquisitions that fit the core strategy. Like buying Lumen's consumer fiber assets for about $5.75 billion that added 1 million subscribers and passed 4 million more locations. Fits right in.
Okay, and what about returning cash to shareholders? Dividends, buybacks.
They've restarted a big share repurchase program, a $10 billion authorization. They've committed to buying back at least $3 billion worth by the end of this year, 2025. The market generally likes that, sees it as a positive signal.
And the dividend, they used to be famous for that.
They did. They currently pay $1.11 per share annually, which is about a 3.95% yield right now. But, and this is crucial, they lost their dividend aristocrat status. Remember that?
Yeah, they had to cut it after the Warner Media spinoff.
Precisely. In 2022, the quarterly dividend went from $0.52 down to $0.2775. So the multi-decade growth story is over. The current dividend seems stable, though. It's well covered by the free cash flow. The payout ratio is around 50%, but the cut definitely reset expectations.
Okay, this brings us back to that paradox you mentioned. Huge investments, strong cash flow. But are they actually creating value? Let's talk about return on invested capital, ROIC. What does that tell us?
Right. This is probably the most critical point for understanding the tension here. ROIC basically measures how effectively a company uses its capital, both debt and equity, to generate profits. For AT&T, their annualized ROIC in the first quarter of 2025 was about 5.23%. If you look at the trailing 12 months, it's slightly lower, maybe 4.8%. Now you have to compare that to their cost of capital.
The WACC, weighted average cost of capital.
Exactly. Their WACC is estimated to be somewhere between, let's say, 6.0% and 6.5%. We used about 6.25% in our base case.
So wait, their return, around 5%, is less than their cost of capital, over 6%.
That's the core issue, yes. Their ROIC is currently and significantly below their WACC.
What does that actually mean, though, in simple
It
terms?
means from a purely economic perspective, AT&T is not generating returns high enough to cover the cost of the money they're investing. Think of it like this. You borrow money at 6% interest, but you invested in something that only earns you 5%.
You're losing money on that deal.
Precisely. Every new dollar they invest under these conditions is, theoretically, destroying long-term shareholder value, even though they're spending billions on necessary things like 5G and fiber. It's a fundamental problem. They need to either increase the returns from those investments or lower their cost of capital, or both, to flip that equation.
Wow. Okay, that is a powerful, maybe even unsettling insight. Let's dig into the financials that underpin all this. That takes us to Chapter 3, Financial Analysis. What do the income statement and balance sheet tell us about AT&T's overall health and potential, especially after shedding Warner Media?
Well, first, you absolutely have to keep the context of that divestiture in mind. It makes looking at things like historical revenue growth tricky.
Right, because revenue obviously dropped significantly when they spun off a huge part of the company.
Exactly. The 5-year average annual revenue growth is negative, around minus 7.25%. But that's noise from the spinoff. You have to peel back the onion and look at the core business growth. Mobility service revenue is growing maybe 2–3%, and fiber broadband revenue is growing in the mid-teens. That's where the underlying momentum is.
Okay, that makes sense. What about profitability?
Gross profit margins have actually been improving, hovering around 60% on a trailing 12-month basis. That's pretty healthy. Operating and net profit margins, though, have been much more volatile because of all the M&A activity, impairments, and restructuring costs over the years. They're currently around 15.6% and 9.6% respectively, but again, lots of noise in the historical data.
And the free cash flow, you mentioned it covers the dividend. That seems to be the bright spot everyone points to.
It really is. Free cash flow, or FCF, is a definite standout strength for AT&T right now. After some volatility, it bounced back strong, $16.8 billion in 2023, then $17.6 billion in 2024.
And the guidance is strong, too.
Yeah, management is guiding for FCF to be over $16 billion again in 2025, and they expect it to grow to over $18 billion by 2027. This strong, predictable cash flow is absolutely fundamental. It's what lets them pay that dividend, buy back shares, and crucially, keep chipping away at their debt pile. It's the engine making the turnaround plausible.
Okay, but let's talk about that debt pile. How stable is the company overall, given that liability?
The debt is still substantial. Net debt is around $121 billion. Now, they've made real progress. They've cut it by over 30%, down from a peak of about $180 billion after the Time Warner deal. That's impressive deleveraging.
But still a huge number.
Still a huge number, yes. And it makes them sensitive to interest rate changes. Also, looking at liquidity, their current ratio is about 0.70, meaning their short-term liabilities are greater than their short-term assets, like cash and receivables. For every dollar they owe in the near term, they only have about 70 cents readily available. It indicates tight working capital. They're heavily reliant on that continuous operating cash flow to meet obligations. It doesn't leave a lot of wiggle room.
Okay, so complex financial picture. Strong cash flow, improving core growth, but significant debt, and that nagging ROIC issue. How is the market digesting all of this? Let's move to Chapter 4, Market Sentiment. What's the word on Wall Street, and how has the news cycle impacted perception?
Well, the overall analyst consensus is a moderate buy. The average 12-month price target is around $29, but the range on those targets is really wide. It goes from as low as $14 all the way up to $34.
That signals a lot of disagreement, or uncertainty at least.
Exactly. It underscores just how much uncertainty there is about whether this turnaround plan will fully succeed and overcome the challenges. The news flow reflects this duality. You see positive stories about strategic focus, the subscriber growth in key areas, that strong FCF, the debt reduction, the buyback.
But then the negatives.
But then you have this significant negative press around the data breaches, the $177 million settlement, which raises cybersecurity questions and maybe damages consumer trust, and also some public relations friction from CEO Stan Kroenke stating pretty bluntly that they'll pass the costs of the new 2025 U.S. tariffs directly onto consumers.
Yeah, that probably didn't win them many fans. What about market indicators, like short interest? Are people betting against the stock?
Interestingly, no. Short interest is actually quite low, around 1.2% of the shares available for trading, the float. That suggests there isn't a strong conviction among major investors that the stock is headed significantly lower.
And the stock price itself. Momentum.
Technically, it's showing positive momentum. It's been trading above its 50-day moving average, which is around $27.60, and also above its longer-term 200-day moving average, which is somewhere between $24.24 and $25.91, depending on the calculation. So technically, the trend has been positive in the short, medium, and longer term recently.
Okay, market seems cautiously optimistic, maybe, but watching closely. Now, who actually owns AT&T? Does the ownership structure tell us anything interesting? Let's look at Chapter 5, ownership structure. Who are the big holders?
Well, it's heavily dominated by institutional investors. They hold a majority of the shares, somewhere between, say, 51% and 66%, and the very top holders are mostly the big passive index fund managers.
Like Vanguard, BlackRock.
Exactly. The Vanguard Group is the largest, holding maybe 8% to 9%. BlackRock has around 5% to 8%. State Street has about 4%. What this tells you is that AT&T is such a large, established company. It's a core holding in countless index funds and ETFs. Millions of ordinary people own it indirectly.
Makes sense. It's a foundational part of the U.S. market. But what about the insiders, the executives, the board members? Are they buying?
This is where it gets pretty striking. Insider holdings are remarkably low. We're talking about just 0.09% of the total shares outstanding.
Less than a tenth of 1%.
Yeah. And recent activity is telling, too. Over the last 3 months, the only reported insider transactions were sales, and pretty modest ones at that, around $41,000 total. There's been no reported insider buying.
So the people who arguably know the company best aren't putting significant amounts of their own money into the stock at these levels.
That's one interpretation, and it's certainly something potential investors should note. It doesn't necessarily mean doom, but it contrasts sharply with the idea of insiders being highly confident in a major turnaround story, at least from a personal investment perspective. It also raises potential governance questions when you have high passive ownership and very low insider alignment.
That's a really interesting point about alignment. Okay, let's confront the potential storms ahead. Every company faces risks. What are the biggest threats facing AT&T's plan right now, especially broader economic or geopolitical ones? This is Chapter 6, Risk Assessment.
Well, briefly touching on a SWOT analysis, strengths are clear. The vast network, the strong brand, bundling, scale, FirstNet. Weaknesses, high debt, declining legacy businesses like parts of wireline, that questionable historical capital allocation record we discussed, and the recent data breaches hitting the brand. Opportunities lie in 5G and fiber expansion, pushing bundled services and growing enterprise solutions.
Okay, but the threats. What external factors could derail them?
2 big macroeconomic factors stand out: inflation and interest rates. Inflation is tough because telecom services tend to be deflationary, or at least prices don't rise easily. So it's hard for AT&T to pass on rising costs for energy, labor, equipment.
Squeezing margins?
Potentially, yes.
Yeah.
And interest rates are a major sensitivity because of that huge $126 billion or so debt load. As rates go up, or stay high, servicing that debt becomes more expensive, refinancing existing debt costs more, and that eats into the free cash flow that could otherwise go to investment, buybacks, or faster deleveraging.
A double whammy there. What about geopolitics? You mentioned those U.S. tariffs coming in 2025. How big a threat is that?
It's potentially a very significant threat, yes. The new U.S. tariff regime targets key parts of the telecom supply chain. We're talking rates of 34% to 46% on certain goods from China and Vietnam, over 20% on things like smartphones and routers, potentially higher on network components.
And AT&T has said they'll pass those costs on.
CEO John Stankey was quite clear. He stated those costs will be passed to consumers. This could mean higher prices for smartphones, which might cause people to delay upgrades. It could also put pressure on AT&T's own CapEx budget if network gear gets significantly more expensive.
So higher phone bills or device costs for us, but what's the real danger here from a business perspective?
The biggest danger, I think, is the competitive dimension. This is where it gets tricky for AT&T. What if their main rivals, maybe T-Mobile, maybe the cable MVNOs, decide not to pass on the full cost? What if they absorb some or all of those tariff costs to gain a price advantage?
Oh, yeah. That could hurt.
It could really hurt. If competitors can offer the latest iPhone or Samsung device significantly cheaper because they're eating the tariff cost while AT&T isn't, that could trigger customer churn. In a market this competitive, losing subscribers due to price, especially on flagship devices, would directly undermine AT&T's growth narrative and financial projections. It's a serious risk.
Wow, yeah, those tariffs suddenly look like a potential competitive minefield. Okay, we have covered a ton of ground. Let's try and pull it all together. This brings us to our final chapter, Chapter 7, Conclusion. Weighing everything, the good, the bad, the paradoxical, What's the core bullish argument for AT&T right now? And what's the core bearish counterargument?
Okay, the bull case really hinges on that prodigious free cash flow.
Yeah.
We're talking $16 billion plus guided for this year, growing towards $18 billion plus by 2027. That cash funds a nearly 4% dividend yield, which is attractive to income investors. And it supports that substantial $10 billion share buyback program, returning capital directly to shareholders.
And the operations.
Operationally, bulls point to disciplined execution. They are delivering consistent, profitable subscriber growth in their core areas. 5G wireless and fiber broadband, they've shown real commitment to strengthening the balance sheet, cutting tens of billions in debt. And they have unique, valuable assets like FirstNet. So the bull story is one of a successful turnaround, a return to basics, driving steady growth and shareholder returns.
Sounds pretty compelling when you put it that way. But then there's the other side. What's the core bear case? What keeps people cautious?
The core bear concern comes right back to that fundamental issue, ROIC below WACC. The argument is that despite the huge cash flow, the massive $22 billion annual investments might actually be destroying shareholder value because the returns aren't covering the cost of capital.
Yeah.
That's a serious long-term problem if it persists.
The central paradox again.
Exactly. Beyond that, bears point to the still substantial debt load in a potentially higher-for-longer interest rate world. They highlight the weak liquidity shown by the current ratio being below 1.0. They emphasize the intense competition that constantly pressures pricing and margins. There's also the drag from declining legacy businesses, like parts of business wireline. And finally, those external threats, the brand damage from cybersecurity breaches, and, critically, the looming 2025 U.S. tariffs potentially hitting consumer demand and creating a price disadvantage versus competitors.
So bring it back to valuation. You ran a DCF model. Where does that place the intrinsic value, considering all this?
Right. Based on our educational discounted cash flow model, factoring in management's free cash flow guidance and using a reasonable discount rate reflecting their cost of capital, we get an estimated intrinsic value range for AT&T between approximately $20 and $42 per share. Our base case estimate falls around $34 per share.
And the stock is currently trading around $28.08.
Correct. So the current share price sits comfortably within our estimated range, and notably below our base case intrinsic value estimate of $34.
So potential upside.
Potential upside, yes, if you believe management can execute effectively, continue to grow that free cash flow, manage the debt, navigate the competitive and tariff threats, and crucially start to improve those returns on invested capital over time. An investment today is essentially a bet on that execution. You have to weigh the positives, the FCF, the core focus, the shareholder returns against the significant negatives, the poor capital allocation history, the current value destructive returns, the debt, the competition, the external risks. The market seems to be pricing in a good amount of this uncertainty, which creates the potential opportunity, but also carries real risk if things don't go according to plan.
What a fascinating, complex picture for such a well-known company. That really wraps up our deep dive into AT&T. The big question left hanging, maybe for you, our listener, is can AT&T truly overcome its past? Can that impressive free cash flow and renewed focus on connectivity routes finally conquer the historical capital allocation issues and the fierce competition? Is reinvention truly possible for a company this old, or are some economic realities just too hard to fight?
A lot to think about there.
Definitely. We hope this deep dive has helped cut through some of the noise, given you those aha moments, and made you feel well-informed without getting totally overloaded. If you did find this valuable, please do like this video and subscribe to the Stock Analytics AI YouTube channel. Remember, members get priority access to our deep dives on all the S&P 500 stocks we're covering.
And that super thanks option is there too for one-off requests.
That's right. Just drop us a super thanks before we go, the important disclaimer.
Yes. This analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Please always conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Sound advice. Thank you so much for joining us for this deep dive. We look forward to exploring more fascinating companies and topics with you next time on the Deep Dive.